Good afternoon, everyone. Welcome to Stock Market Today. It's Coram and Ed Carson here with a look at the market action today and this week. And we definitely got a bearish signal. The constructive action that we had been seeing in the market, Ed, definitely took a bearish turn on Thursday, and more big losses today on that CPI reading.
Yeah, and the market seemed to be doing fine to start the week, and then it got a little worse and a little worse and a little worse, like going on a river trip, and all of a sudden the rapids pick up. So a lot of weakness there. We do want to look at a few stocks that are holding up reasonably well. Northrop Grumman, Onsemi, and Albemarle.
All right, well, we will analyze those charts for you. But first, let's take a look at the major indexes. The Nasdaq taking a hard hit Friday, down 3.5%. We also had the S&P 500 down at 2.9%. The Dow off by 2.7%. And the Russell 2000 also down 2.7%. And the worst week for the S&P 500 since January. And some key levels on the charts of the various major indexes to review, Ed.
Yeah, yesterday, well, let's just go through the market week.
Right.
The first couple of days, not a whole lot happened. It was, fine situation, and holding above the 21-day moving average back and forth. So that was relatively positive. We didn't know where we were going. A lot of handles were forming. But I will note that on Wednesday, while the major indexes looked okay, there was a lot of damage among breakouts. We saw, some big breakouts like AMPH just had this catastrophic failure, and it was not alone. If it was just one, that's the way it is. And that selling continued the next day. And then we saw the shipping stocks have this meltdown. We saw a lot of other sectors like Zim, here, selling off really sharply on Wednesday, and it kept on going. And we had this, LNG plays, FLNG, there's a lot of different things going on. So a lot of sectors, a lot of stocks, a lot of breakouts really started failing on Wednesday. So even before the major indexes looked weak, it was like, this is not good action. And then Thursday, okay, it tumbled through the 21-day line, all the moving averages. We'll look at all the various indexes and various things, but they're there. The 12,000 level on the Nasdaq. So with that, and with the leading stocks continuing to struggle, we put the market under pressure. Even though the indexes weren't that bad off, just by that. But today, Nasdaq plunges again, market plunges again. Inflation was supposed to dip a little bit. It accelerated again. And so, we'll look at the Treasury yields in a little while, but it's already looking like we're going to have, we're going to have a 50 basis point hike next week, which we already knew. But there's now multiple, brokerages saying, hey, they should hike 75 basis points. So, okay, long story short, here we go at Friday, is that we closed below the low of the May 26 follow-through day. And why is that so important? Well, Eric Kroll, who's been a frequent guest on IBD Live and other podcasts, has done research showing that if you close below the low of the follow-through day, there's a 90% chance that rally will ultimately fail. Now, this rally will still go on as long as the Nasdaq is above its ultimate lows earlier in May, but this is a very bad sign. And when you can combine it with how the leading stocks, the indexes look bad, but the leading stocks look even worse. So it is a very, very negative signal what's going on right now. We may very well be in the midst of starting the third leg. We haven't really gotten there officially, but you can sort of that up and down kind of motion. We certainly seem to be headed toward that. And, often bear markets have that third leg. And so that's where the risk is. Obviously, the Fed meeting next week will be very important. So that could be a big catalyst, but it's just as likely to be a big catalyst down than up.
Right. We're definitely looking at that potential scenario. Step one, let's see how we act around those May lows, as you mentioned. Is that going to be a support level? Are we going to stop there? Are we going to break right through it after that? We could be looking at 10,000 or 98.40 on the Nasdaq. That would be roughly a 20% decline for a third leg, and something that David Ryan analyzed in detail this morning, phoning into IBD Live. And we actually just published, shortly before we went live here on this show, a clip from today's episode. So you all out there can get the inside scoop directly from David Ryan, his thoughts on where we are in this market. And we'll be sure to get more thoughts from him, of course, on Tuesday next week in his 90-minute weekly appearance, Ed. But let's also take a look at the S&P 500 on the weekly, because at the beginning of the week, this shouldn't come at a complete surprise. It's never fun, but we, in the spirit of being open-minded, we were saying, hey, the S&P, if you look at it on the weekly, right there, resistance at the 10-week, keep an eye out for that.
Yeah, and that's, we didn't know. It was like, could we break through it? And there was a lot of risk that we'd hit resistance at the 10-week or the 50-day line. Never got to the 50-day line, but got right up to the 10-week, and boy, really negative selling here. And on a daily, I'm not sure if it's going to show up quite through. It's a little delayed, but we did close like at 3,900, and it was like just literally we closed, I believe, 0.03 point below the lowest close. So this is the worst close, and maybe the numbers will have changed. Sometimes they update them just that little bit. I'm like in the official
like a
scores.
SPY.
Yeah.
So you can see, yeah, it's right there.
So it's going to be, it's right at a 14-month closing low. Now, we didn't have a follow-through day on the S&P and Dow. So, yeah, it closed below the May 26th low. Heck, it closed below the May 25th low. But that doesn't really matter because we didn't have a follow-through day on there. But still, it's bearish action on the S&P and Dow.
Yeah, 14-month closing low. Wow. All right. Well, speaking of the Dow, let's just take a quick trip there. Big resistance at the 10-week line here for the Dow.
Yeah, and that's pretty much on the same stuff as the S&P. There really wasn't much, no places to hide.
Mm-hmm. And the Russell 2000, we can see this was maybe another little tell from Wednesday. Tuesday, with the IWM ETF tracking the Russell 2000 getting above the 50-day line, and then the following session on the 8th, turning tail there before breaking lower.
Yeah, that was really negative. And so another point is that on the breadth on Thursday sell-off, even before the market was really selling off, the breadth was terrible. And the small caps were sort of leading that decline on Thursday. Really disappointing because, back on Tuesday, things were starting to look pretty promising, but it was just at that moment when everything started to get weak.
Mm-hmm. And of course, with the Fed being put in a tough spot here to tame inflation, eyes are on the 10-year Treasury yields now more than ever, perhaps. And this has been the big theme this year, but a big move up in yield earlier this week, getting back above that 3% mark. And now it looks like, Ed, we're at the highest levels, or at least close to the highest levels in a very long time.
Yeah, and that 3.25, we're looking like at a decade high. So right on that doorstep. And as big of a rise as this was for the 10-year yield this week, and it was big, the 2-year yield had an even bigger rise. And so that's a sign of that people are concerned not just about inflation, but about the economy, the Fed is going to have to be more aggressive, and that's going to slow the economy. And they're going to have to be even, more aggressive than we thought a week or so ago. And it's just going to be very difficult to bring down inflation without causing a recession or nearly doing so. And rising costs, weaker growth, it's just a terrible recipe for profits and for sales. So it's not going to be easy for businesses and for stocks to do well in that environment.
Yeah. There is a trade, though, that can give you a little bit of exposure to this, one that we've been tracking with an ad on the 31st for TBT or TMV. This is the triple leveraged inverse of the 20-year bond. And that's been working out right now. But again, just something that we are keeping a very close watch on here, Ed. And let's also take a look at how the energy sector fared this week, coming off a bit Friday, of course, with the broad-based bloodbath. How about that for your Friday tongue twister? Down 1.7% for the week, though, just down about 0.9%, but still in a very strong overall uptrend.
Yeah, and this might be mitigating, or like we're not as reflective of how some of the energy sector. Obviously, we looked at some LNG plays, but it's also, this is so dominant by Chevron and Exxon, which had relatively
True.
strong weeks. There were some others, but that's always the case. But yeah, energy, while yeah, it may have come down a little bit, yeah, that's clearly been the one sector that's been strong all year. And you know, that doesn't mean it's going to continue to be strong, but this is the one sector. There's other ones that have come and gone. This is the one that's been holding up reasonably well, or not just reasonably, it's been holding up well throughout the year.
Yeah, fantastically well.
Yes.
Okay, let's also take a look at the metal and mining group. This is one area where we're starting to see some signs of life in recent weeks, but not the case Wednesday through Friday, getting slammed at a key technical level.
Yeah, just like the small caps, just like everything else, Wednesday was really the day, even though you didn't see it on the major indexes. That was the day when things turned, as it turned out, you know, really was a turning point, and it just got worse from there.
Okay, and let's check in on our friend ARKK, taking a huge hit today, down 7.2% for the week. Looks like it was down about 7%, but resistance coming up to that 10-week line. And so speaking of closing lows, closing low here for ARKK going back to its COVID days.
Yeah, I mean, it tried to bounce and it was looking sort of positive. You could, you know, for a while there's sort of like the small caps. It didn't go underneath the lows in, you know, in late May, like, you know, the major indexes did. So that's one positive. And, you know, it still hasn't, but it's getting back towards its later May lows. And we'll just see. It's just, look, there's not much working right now. And while these names can have big gains, they can have big losses too.
They absolutely can. Okay, well, let's take a look at some stocks that might be holding up or faring better in the current market. One is Northrop Grumman. It looks like we did get a little bit of an upside reversal by Friday's close after a test of support once again at the 50-day line, closing up by about a 0.5%. A breakout not all too long ago out of a cup with handle, a long handle here. Guess you could look at a shorter handle within the handle here, but pulling in. This is I think a good example of a couple of things where it's, even with a strong relative strength stock, buying breakouts is very tricky, but something like this is good to keep on your watch list because it is bucking that overall weakness and finding support where you'd like to see it.
Yeah, this is why you want to be watching things, not really buying, because it's just so tough. It's so tough. This is definitely one to watch because the relative strength line is so high. You know, it's finding support at the 50-day line, and it wouldn't take much to be in a buy zone. So it's yeah, and if it did get to that breakout point, at least it wouldn't be far from the 50-day line. That is an issue with a lot of stocks, is that some of them ran up so much after these huge things that, you know, that they're still far away from their 50-day lines. This one is not. So that could provide you a little bit of security. If it ran up to the buy point and you bought it, there would at least be a pretty obvious support level and, you know, and sell signal if it can't hold that.
Exactly. Okay, and next let's take a look at Onsemi, ticker ON here. One chip stock that is holding up around its 21-day line and above its 50-day and 200-day lines, working on a base here, Ed. But it still didn't have a great week. I mean, down 4% on Friday, a little over 4% for the week, reversing lower. But on that weekly chart, it is showing an RS line blue dot.
Yeah, I mean, a 4% decline and you have an RS blue dot. I mean, it's not good, but there's that declining trend line. And you could argue that this weekly decline on a weekly chart is a handle as well. So that trend line and that sort of lines up. On a daily chart, that'll be valid as of Monday's close, you know, presumably, assuming it doesn't plunge. I mean, which could then it looked like strong weekly volume on the downside, but really most of that volume was on that first day that was up. So I mean, it was above average volume the rest of the week, but the really big volume was on the up day. Look, I mean, this is, you know, I think our investors care about it. You know, growth stocks, this is one that's hanging on. It doesn't mean it'll keep doing so. This is with everything. And it is a fair amount. The buy point would be a fair amount away from the 50-day line. So those are things to to watch out for. It would be great if this could consolidate for a few weeks, and that would be something that if the market could go sideways for a while, that could be useful. But definitely one to watch. Definitely one probably to be. It's more on the off position right now, though. It's and then on.
Yes, exactly. All right, that all makes sense to me, Ed. And let's also check back in on Albemarle. A bit of a wild couple of weeks here, but it is holding up in a base pattern below its 21-day line. It was able to find support at that level until just recently, but all in all, once again, this is a stock that's holding up better than most. For a watch list name here, seems like there's a couple of compelling reasons to keep it on a list.
Yeah, I mean, for one, there's a broader growth story that the prices should stay relatively high, though there was a negative call. There's reasons why, but oddly enough, is that while it has a wild-looking handle on a weekly chart, I believe this was another inside week. Now, I may have dropped at the very last minute, but barely were inside weeks for 2 straight weeks. So sort of tightening up in its own vague way. Believe me,
relative strength, relative tightening.
Yeah, it's like bell bottoms saying I'm wearing a relatively tight bell bottoms or something. I don't know. It's just like or 90s puffy wear or something. But it's it's come back down below the 248 early entry. I think we could sort of not stop talking about that. There is a cup with handle buy point a little above 273. I suppose that this week's high could serve as an early entry, sort of, you could sort of see a declining trend line, sort of getting above Wednesday's high, sort of could serve as maybe a way to get in. Again, you need the market to get better. I mean, it'd be nice if this could shape up. The 50-day line is trying to catch up, but it still has a long way to go in the context of if this actually got up to more reasonable buy areas, then it would be really extended again. So it'd be great if this handle became long enough to be its own base, so these are watch lists. I really, and I know that you were making that point too, but there's a lot of stocks you can look for watch lists, but look for relative strength. And some of the charts will look damaged. Some of them may look really damaged, but there may be plenty of time for these charts to repair themselves. This one just needs to, continue to do well, but look for the relative strength.
Yeah. All right. Well, as we wrap, so it sounds like, Ed, now is not the time for investors to look for stocks to buy. It's the time to look for stocks for your watch list. And many of them, as we've shown today, just need time for their charts to look better and time for the market to start looking better. And it's also a time to assess that portfolio, look at your exposure, see if your risk level is appropriate right now, given the kind of conditions that we're in. And I don't know about you, but I'm pretty light in this market. Have a little TBT and a tiny position that I've been taking profits into strength in an energy name.
I have basically said, I'm just going to let my 401k be my exposure at this point. Yes. Because it's I mean, there's a lot of, even if you didn't pay any attention to the market, chances are, with a few exceptions like certain energy, chances are if you took positions in the last couple of weeks, they're down. I mean, most stocks are down. There's a few that are going to be up. But so you'll probably wanted to get out of those names, especially if they round tripped and things. And even if you're in stocks that are working well, we've seen things where some big losses. We were looking at a few of those things where it can just happen, snap, just like that. So you have to weigh that risk in this environment. How much reward is there really in this negative trend? And that's interesting. You may want to take at least partial profits, even in stocks that by themselves seem to be looking good.
Yeah, totally agree, Ed. All right, well, thank you so much. And thanks everyone for tuning in as always. If you want more content, we got one more video coming up for you today, and that is Stock Tales at 5 p.m. Eastern live on my YouTube channel. We'll also post that at investors.com/videos. Rachel Fox on our markets team is joining me today, so it'll be good to catch up with her, get her thoughts on the market, and to learn about some in-depth fundamental research she's doing for a name that I'm seeing a lot in FinTwit land. So that'll be fun to chat about. So check it out on my YouTube channel coming up here in a bit. Thanks, Ed. Hope you have a great weekend. And thanks everyone for watching. We'll see you next week.